Because the put side is bullish and the call side is bearish, when you do it simultaneously, that equals what we call a neutral trade. It's inherently neutral. So normally when you're doing a traditional strangle, you're selling it at the same delta on each side. So for example purposes again, so the strangle is not a basic trade in our opinion here at the Dorian Trader. It has basic components because selling a naked put can be super, super conservative, if not the most conservative strategy, period. Because if you're okay with taking ownership of the shares, that's better than buy and hold. You can always wait until the stock comes back. If you sell a naked call, then that can be advanced if you don't understand how to manage that risk because you and let's break down how to do a strangle trade. It's several components of a strangle that you want to understand. The first thing is that you are selling a naked put. You're selling a naked put, and let's say in this example here, we decide we're going to sell this 14 delta put. When you sell a put, you are bullish. You want it to go up. You're positive on that underlining. So in this case, we're positive on Disney if we were just selling a single put. When you're doing a strangle, you also sell a naked call. And I just sell this at the 14 as well. When you sell a call, then you are bearish. When you sell a call, you are bearish. You want it to go down. You're negative on that underlining. When you sell a call or a put, monies are coming into your account, coming into your purse, coming into your wallet that you never have to give back. You are acting as that insurance company, using that analogy that you hear us talk about very, very often, is that if you go to a progressive and you give them $1,000 to insure you for a month, or excuse me, 6 months, if you give them $1,000 to insure you for 6 months, if you get in an accident within that 6 months, then Progressive can put that premium toward your accident. And so if your accident doesn't supersede that premium and your deductible, if you have one, then Progressive still wins. Right? So they never have to give back that premium. Even if you have an accident that supersedes, that just means they're going to lose on that policy at that time. The most of the time they do not lose on their policies, but they lose on policies often. But the risk is spread out, just like casinos. And casinos lose often. They lose often on blackjack. They lose often on their games. But they understand the risk management, so when they lose, the losses are small, and they're able to win over time based on their probabilistic edge. And so when you are selling a strangle and you're doing it at deltas no higher than a 15 delta, ideally lower than that. But if you're doing a here at the Dorian Trader, but if you're doing a strangle at those levels, you're going to have at least a 70% chance of winning at expiration if you're doing it at no higher than a 15 delta. Because if you do the put side, you sell that naked put at a 15 delta, and you sell that call at a 15 delta, and you add those up, that equals 30. If you subtract that 30 from 100, then that's going to equal a 70% chance of winning at expiration, winning something, not necessarily what you received, like that using that insurance example again. If you pay Geico $1,000, they just say they had a 70% chance of winning, but not necessarily that whole $1,000. Not necessarily that whole $1,000, but winning something and not losing on you. And that's how you should think about it as a primary option seller in the open market. Is because that's literally how probabilities with options are set. They're set based on winning something at expiration, not what you received. Right? Most likely you're going to win something closer to what you received, but that's not how the probabilities are set up. So if you're doing this strangle, you are selling a put and you're selling a call simultaneously, and it looks like this. Because the put side is bullish and the call side is bearish, when you do it simultaneously, that equals what we call a neutral trade. It's inherently neutral. So normally when you're doing a traditional strangle, you're selling it at the same delta on each side. So for example purposes, again, you're selling the put side at a 15 delta, you're selling the call side at a 15 delta. Delta wise, that's the same, so it's inherently neutral. You want it to stay in between your short strikes. So this is the short strike on the put side in this example, so you can see it. This is the short strike on the call side. You want it to stay in between the two short legs because this is where you can win at. Okay? This is where you can win at if it stays in between there. Now, if we go to this curve view, and let's break this down a little bit. So this is the at the money line. This is the put, and this is the call. And because of the premium you received, you do have some, based on this example here, the way we set it up, right? The way we set this up, this is your win zone right here. This is the win zone, but it's basically staying in between the two short strikes, okay, like this. And if it goes down, you have risk all the way to zero if it goes down, right? Because this is your loss zone if it goes down. If it goes up, you have technically unlimited risk. I like to say theoretically unlimited risk because nothing's going to go up into perpetuity. You're not going to be in the trade forever, but it can feel like unlimited risk if the stock shoots up significantly over above your call strike. So you have theoretically unlimited risk to the upside when you do a strangle. A strangle is a super high probability strategy depending on how you set it up. So let's go back really quickly. Let me set this up the way we would normally set it up. Right? So if I go over here and I just say we sold the 8 delta here, you can sell at the Dorian Trader no higher than the 15 delta. And I just say here we decided we're going to sell the 12 delta. Right? So based on the probabilities, TastyTrade is saying we have an 85% chance of winning something at expiration and a 92% chance of winning at least 50% of this 130 that we're receiving. It's jumping around right now. So if we jump back over here to this curve view, and so now you can see, and I can make it maybe a tiny bit smaller. And let's go here, put that back to 100. And so now you see this strangle the way it looks when we set it up. This is the at the money. This is your win zone, as you can see. If it stays in between the short strikes, this is your win zone. You want it to stay in between this call strike and this put strike. If it goes down too much, once again, you got risk all the way to zero. And if it goes up, like I said, I say you have theoretically unlimited risk to the upside. TastyTrade is saying, once again, you have an 85% chance of winning something at expiration, 90+% chance of winning at least 50%. And then you have some buying power that you have to put up when you do these trades. If it's a company that is established and not considered risky by your broker's firm or the exchanges, you're going to have usually about 20 to 30% you're going to have to put up of your max. Well, in this case, the stringer, you don't know what your max loss is, but you're going to have to put up about 20 to 30%. And this is what they consider your max loss is when you initially put on the trade. So this is trading at 117, right? So if you got 117 times, let's say 100 shares, right? Times 100, that's 11,700. So if you take the 1171 divided by 11,700, that's going to be about 10%. So that's less than 20%. That's less than 20%, less than 30% that they're asking you to put up to do this trade, right? So the strangle is not a basic trade in our opinion here at the Dorian Trader. It has basic components because selling a naked put can be super, super conservative, if not the most conservative strategy, period. Because if you're okay with taking ownership of the shares, that's better than buy and hold. You can always wait until the stock comes back. If you sell a naked call, then that can be advanced if you don't understand how to manage that risk, because you could if be required, because you do have an obligation to sell shares to the buyer. So if you're exercised or assigned to do that, then if you don't have the monies in your account, that can be challenging. And that can be challenging. The brokerage firms, they obviously don't want to wind up taking a loss for because of your trading skills. They're going to continue to increase the buying power. If you don't have it, you're going to get a margin call. So most likely you're going to have to get out of the trade regardless if you don't understand how to manage that call side. So because I think the naked call can be challenging for at least most beginners, then I consider this a more advanced strategy. But one of the interesting things about the Strangle is that it's one of the easiest trades to adjust. It's one of the easiest trades to adjust. It's easier to adjust the Strangle than an Iron Condor, which is very similar to a Strangle, except you don't have unlimited risk to the upside or risk already zero on the downside, because you have more defined risk for an Iron Condor. The Strangle is basically undefined risk on both sides. Obviously, it can only go to zero, so that's defined. But if something's trading at 100 and it goes to zero, that doesn't feel like defined risk. At least in my world, it doesn't. But people at TastyTrade, this is their primary strategy. This is what TastyTrade, Tasty Live, obviously the founders of TastyTrade, who were the founders of Thinkorswim. This is their primary type of strategy, is a strangle. So it can be a very, very powerful strategy. It's just something that you have to be accustomed to. Ernie does this strategy a lot with his long dated, right? And he had major success for most years. He had a 40+% last year. And so, and I expect by the end of the year he's going to be outperforming the market again. He knows how to trade these strangles. He knows how to trade these strangles.